Let's keep going, Paul.
Yeah, so now we're doing Dollar General.
Dollar General, Paul. Tell us about this company.
$48 billion market cap, so about $50 billion. PE, barely below 20, but it is a check mark.
Nice.
Profit margin, says right here 7%. In the last 12 months, it looks about right, about 7%. So that's an X there, sorry. It's below 10. Again, these are not set rules. They're just ways of screening things. And a dividend yield of 0.75%.
How
what
adorable.
do we think about that?
Adorable,
That's
as Paul
adorable.
would say.
That's 375, let's call it $400 million to be conservative. It's actually lower than that, it's more like 360, but we'll call it $400 million right now based on this. So, right now, one check, one X, $400 million in dividend yield, so we have to make sure that the free cash flow can easily support that.
Pillar number 3 is revenue growth over the past 5 years.
Revenue growth of the past 5 years. 20 versus 27.8. Check mark there. It's surprising because they tend to do better in recessions. This is one of those companies that in recessions will do better. A lot of growth. Again, how many were because of store locations being open versus how much were in same store sales increases.
Pillar number 4 is profit growth over the past 5 years, Paul.
1.165, 1.7. Check mark there.
Okay, are you formulating your growth factor number for pillar number 8 already?
I'm thinking about it.
Pillar number 5 is the shares outstanding. We want this number going down.
294 to 256. Check mark there. Nice. So they're buying their shares back with their free cash flow.
Current assets over current liabilities is pillar number 6. All of these pillars you will get with the Everything Money app in April. So it'll take much less time for you to evaluate companies. Pillar number 6 is current assets over current liabilities, Paul.
$7.5 billion in current assets, which is basically cash on hand, and $5.9 billion in current liabilities. So check mark there.
Check mark there.
Got a lot of check marks here on the good old DG.
Yeah, this is Dollar General. The only X we have is the profit margin, which is a little low.
But that's expected for a company like this.
Free cash flow growth is pillar number 7, Paul.
Free cash flow growth.
Go ahead.
800 million, 1.5 billion. Check mark there. And remember, their dividend was about $400 million, actually a little less. So they can easily support that dividend here. Now, for the average, 1 billion, 1.2 billion, 1.4 billion. Wow. This is going up consistently, guys.
The average is 1.18 billion, Paul.
1.2 billion times 20, 24 billion needs to fall in half.
Uh-oh.
Now, keep in mind, guys, this is a good company for recessions. It tends to do well in recessions because as people make less money, they're looking to save more money when they go to Dollar General. I do still think, even though the PE was under 20, something's telling me a different story about why is it telling me, oh, well, that's why, because obviously this thing has jumped up a lot. So the question becomes, how have they done in the last year? Let's see how their free cash flow has gone in the last year, guys.
While Paul's looking at that, make sure you tickle that thumbs up. We really appreciate it. Paul loves to be tickled on his nether regions, and we appreciate you tickling him. And the thumbs up. That's all you have to do. All this information bringing to you. Oh, go ahead, Paul. What are you finding?
Wow. Big jump in free cash flow, up to $3 billion. Now it's selling for 16 times free cash flow. Versus...
Wait a minute.
Okay, so we had a bad year economically. Drove up Dollar General because a lot of people probably went there to save their money. So if you guys look right here, let's look at quarter by quarter. This is what I want to show you guys. Part of the thinking that's involved when you see numbers and say, what is going on here? Why did their free cash flow go from 1.5 billion to 3 billion in 1 year? Here's quarterly. So look right here, guys. Look at these quarters. Look at these cash from operations. 575, 556, 530, 577, 1.7, 1.2, 476.
Good Lord.
So because of this, I am not giving them the $3 billion in free cash flow ongoing because they're already back to normal levels now. So I still think this is the company that even though the last 12 months have been very, very good, I believe that it'll stabilize back to more normal levels and you still need to pay a lot less money for the company. That is my personal opinion. Again, make sure that they're opening stores but also getting their same store sales price growth up. And I'm going to look at that while Mo talks about his stuff.
Go ahead, Mo.
Okay, so Dollar General is, since November of last year, definitely in a downtrend. Now, this is pretty boring. Let me bring you over to the daily chart, which kind of shows all of this mess. So right now, this white line here is the 200-day moving average. Turquoise is 100-day, the purple is the 50-day, and the yellow is the 25-day. So in order for this stock price to get through all of these moving averages, what we're going to need is a lot of energy. Energy is volume. And this is going to be a big driver. This green candlestick right here, this green volume stick right here, we need several days of that in a row to drive this thing into some kind of positive momentum. So right now with Dollar General, I'm probably not touching it. I'm just sitting here and waiting. And if you want to keep it on your watch list, go for it. But this is a tough stock to trade right now just because it has a lot of things going against it from a technical standpoint.